Let's take a look at your market news now. We'll start in Asia, where markets were mixed, with investors struggling to track another record lead from Wall Street that was fueled by more strong earnings and a jump in U.S. economic growth, while China-U.S. trade talks come back into focus. Now, after a shaky performance last week caused by global growth worries, regional equities got off to a positive start, and the broadly upbeat mood saw higher-yielding currencies make inroads against the dollar. Japan's markets are closed all week, but the Hang Seng in Hong Kong moved up 1% to 29,892 points, while the Shanghai Composite slipped 0.8% to close at 3,062 points. In the US, the S&P 500 and Nasdaq edged up on Friday, rising just enough to notch record closing highs for the second time as investors digested mixed corporate earnings and economic data. The Dow Jones Industrial Average picked up 0.33% to 26,543 points. It was another record-breaking day on the S&P 500, which moved 0.5% to the good, closing at 2,939 points. And the Nasdaq Composite added 0.33% to 8,146 points. Let's get some more market news for you. Arabile Gumede is standing by at the Johannesburg Stock Exchange. A very good afternoon to you, Arabile. It looks like there's blood in the water behind you.
Yeah, there certainly is blood in the water there, unfortunately, in Zing. It's around 0.5% lower today, and one would have hoped that the GDP data out of the United States last week, Friday, that came out better than expected at 3.2% for the first quarter between January and March, that is, would have perhaps boosted the market somewhat. But as you saw, a bit of a mixed picture out in Asia and also negativity out as well today. It's a mixed picture as well out in Europe too. So clearly the sentiment not filtering through. There's still fears of global slowdown as well across the board, and it just does seem that there is no equity impetus thus far. But of course, we do await the Federal Reserve, which is expected to make to start its meeting on interest rates tomorrow as well. All of that is set to shake up the market, perhaps, even if it is just a little. For now, however, let's check in on those numbers and we'll have a discussion around what exactly is moving markets. So that Rand picture has certainly looked a little better at 14 Rand 33 against that US dollar. But one thing I can tell you, however, is that it floated around 14 Rand 50 just last week sometime. And yes, it has gone ever better. But we'd love it to get to 14 Rand if possible at all. Is there anything that can move it to that? Chantal Marks from FNB Wealth and Investment here to perhaps give us some crystal ball conclusion with regards to that. Does that Rand get any better if the Federal Reserve decides to keep interest rates as they are?
Well, if the Federal Reserve decides to keep interest rates as they are, it kind of starts maintaining the status quo of a more dovish or accommodative central bank rate environment globally. And that generally should be good for emerging market currencies because our interest rates are a lot higher than their interest rates. A cut will be even better for the Rand. Odds of them actually increasing interest rates are exceptionally low at this point in time. So perhaps it won't be a big market mover, but if they decide to do nothing, it'll certainly be positive for the Rand, or at least supportive for the Rand at these levels.
Okay, so we want to get the sentiment then out of that Fed Reserve as they meet, then start meeting from tomorrow out in Washington, D.C. What are the key permutations, the key elements that they look at? What is it that will decide whether they decide to keep things on hold? And a lot has been put on, the trajectory moving forward, where it is they see themselves as a Fed from here on in.
So inflation remains key, and at the moment it seems as if inflation in the US remains quite subdued. We have an inflation print out late today, so if this interview were tomorrow, I'd be able to give you a lot more detail. But the reality is that inflation seems to be in check, despite the fact that the US job market is quite robust, and it seems as if they're still operating at full employment, and wage inflation is coming through. It just seems as if demand really isn't there at the moment, and that's what's limiting inflation. And again, the Fed don't actually look at headline inflation or inflation that includes the impact of fuel increases, which would be influenced by a much higher oil price. Yes. They look at the core number, and the core number is actually still quite weak.
Sure. Okay. So what does that say then? They keep things on hold for now, and they perhaps wait for exogenous factors and things to perhaps get worse, or do they perhaps preempt a lot of those moves?
So in terms of preempting a lot of those moves, it's quite difficult to say at this point in time because there are still quite a few risk factors in the system. I'm thinking specifically around the US-China trade war scenario. Even though it's more or less on hold, there are still risks over there. Sure. And then there are other geopolitical risks to take note of, not only surrounding the US, but also the rest of the world. We still have uncertainty around how this Brexit story will play out. We have uncertainty around how long we could still maintain a kind of a growth scenario from a global growth perspective. China's growth is starting to look a little bit better, but if there's any sort of meaningful downturn there, it will be bad for the entire world. Do they preempt any sort of negativity or inherent negativity around growth and actually cut rates? I don't think that is actually on the cards right now. They'll probably keep things fairly steady.
Okay. So steadiness is the name of the game for now. But you mentioned the China-US trade deal. And now I'll link it then to the GDP number that they brought out last week at 3.2%, because their trade deficit was one of the numbers that came out with regards to their GDP. It wasn't as worse as one would have thought, and perhaps it helped the sentiment. If they do sort out their China trade issue, does that mean that GDP figure looks even better then moving forward?
Well, it depends on what the terms are. At this point in time, they have quite stringent tariffs on Chinese goods. So from a trade balance perspective, it is favored towards the US at this point in time. Yeah. A trade deal will likely result in concessions being made on both sides, but it could see the US making concessions from where they are right now, and that could then again be negative for GDP growth. But what really is the thing to watch in terms of US GDP is what that consumption number looks like, that household consumption expenditure number looks like. It disappointed this time around, which is also probably why you didn't see a massive big reaction this morning out of Asian markets and even globally. And that makes up 70% of their economy. So even more important to watch is domestic demand, aside from just this, or not just, but the China-US trade scenario.
Okay, cool. So we've had all of that economic data now, and that's going to still be of key significance. But if we turn to the equity front, still in the United States, we've seen Facebook, we've seen Microsoft, we await Apple, but one that we're going to look out for very soon, and that's today, is Alphabet, and those are the owners of Google. How keenly will the market be watching that?
I think the market will be very keen because it makes up a big chunk of the S&P 500. It's got one of the largest weightings there. It's got a major weighting in global equity indices as well. Major weighting in the Nasdaq. And even though we have had some other tech stocks report results and they've mostly been better than expected, Google will be very closely watched. From a revenue perspective, we're still expecting some really strong growth, around about 20% year on year for the first quarter. Sure. But earnings aren't actually expected to grow by that much because they have a bit of a foreign exchange headwind and a pretty demanding base. So we only expect earnings from Alphabet to grow by, or Alphabet, which is Google's parent company, to grow by about 3.5% year on year for the first quarter. Any sort of beat there will be very positively perceived by the market because it makes up such a huge chunk of those indices.
We'll certainly keep up to date with that one. But I want to quickly jump to that oil story as well. $75 a barrel is where it was sitting at some stage last week. Now 71 odd. It's certainly coming down. Donald Trump pressuring OPEC to up production, and it just seems they're all covering up for what was a story that the United States created themselves, and those sanctions against Iran. Yeah,
I mean, it's all quite interesting because he wants OPEC to produce more in order to bring down the oil price, but they haven't extended their kind of, well, they had a, what do you call it? It's the sanctions against Iran were implemented, but it wasn't necessarily extended to all kind of oil
Yes,
purchases,
so
right?
it's just a short waiver on some of the things.
Yes, a waiver.
There
So
we go.
in terms of the waiver, it was not extended. So it's almost kind of like a self-inflicted pain that they've brought about themselves. But there are a lot of things to consider here, and I think Donald Trump is also considering kind of the geopolitical risk associated with him not taking a firmer stance against Iran, even though he has said to Americans that he is going to take a firmer stance on Iran. So pressure on OPEC to produce more in order to bring down that oil price. But yeah, I mean, I think it's pretty well supported at current levels. You could see it come down a little bit more. But I don't think OPEC is exceptionally keen to have the oil price fall by too much.
Yeah. Look, $70 a barrel would be a good start for us, especially considering where that fuel price has now gone to another increase. Brings us 41 cents away from our previous peak of 17 rand 9 cents. But Chantal, thank you so much, and thankfully you don't have to transport your way here. It's just a walk, right?
Yes,
so
absolutely.
Thankfully, we don't have to worry about that petrol story there. But that is how the markets currently look. Of course, 0.4% lower at present, and that we had hoped that it would test that 60,000 point mark. Perhaps it's still on record and still could happen, but for now, it doesn't look to be headed in that direction. So that is how things look for now. Even a weakness in South Africa's rand. Where exactly will the market go? We'll continue to unpack that. For now, that's where the buck stops. It's back to Nzinga right after the short break.